The dilemma for Australia is that we now have seen 3 years consecutive of net negative earnings growth for corporate Australia. That hasn't prevented the market from reaching a new all-time high, but that means that a lot is riding on next year's forecasts and the outlook for next year. Now, the irony here is that in that growth outlook, AI might still be a very important component, whether we like it or not, because we're now living in a context where at the very least, the RBA is not in a hurry to add more rate cuts. And that might mean that we are looking towards a rather sluggish domestic economy. Now, the irony is that a lot of companies that haven't genuinely participated in this bull market over the past 3 years, can they then participate next year or this year when the outlook for next year might actually not be that fantastic? Being Australia, obviously resources, energy companies are always very important. We are counting on the fact that interest rate cuts by the Federal Reserve and stimulus measures by China are keeping the forecasts positive for next year. That might be the obvious catalyst to get the index to higher highs next year. Offsetting everything I just said, we are going into the midterm elections next year in the United States, and traditionally that is the least favorable year out of the 4 in a presidential cycle. So I think here too, I would have a lot of question marks going into 2026, and I think keeping an open mind and being flexible and nimble. That would be my best approach.